Hey there guys. So for this video here we're going to be looking at your accounting standard for level 2, which is 2.3. And now this standard is looking at processing financial information and creating your financial statements for a sole proprietor's business. So the first thing about this, first thing about this is what are balance day adjustments and why do we need to do them. So balance day adjustments are a pretty key part of this standard. Sorry, I'm a bit sick. But yeah, so balance day adjustments are a pretty key part of this standard. So you're looking at you're looking at showing some information and inputting it into your business's financial statements that haven't been recorded in the year so far. That's the general gist of it. So guys, in our NCA exam, we're going to get a trial balance. So this here is your classic debits equals credits. I explained it in my introduction to NCA accounting video, but pretty much your debits, which are your assets and expenses, are on the left side, and they're equal to your credits, which are your liabilities, your income, and your equity. So this is the trial balance, and this is the trial balance that they gave you last year in the last exam, or if depends what year you're watching this, but in the 2024 exam. And now what they're going to give you is this here, and this is your information that you need to add, adjustments that need to be made. So just looking here, there's a few different things, not too much, but all of these bullet points here in the middle is what we're looking to input into our trial balance and then later on put into our financial statements. Okay, so coming back to this here, guys, and now this is really key. So in our trial balance, we're going to be adjusting the numbers of some accounts and creating new accounts. So it's really important that we understand how to change debits and credits. So if something's a debit, it's on the left-hand side of your trial balance. It's an asset or an expense. To increase it, we say we debit it to increase it, or we credit it to decrease. Now, this is just the terminology, guys. So technically, if it's a little bit hard to wrap your head around, just think about increasing and decreasing and don't worry about debiting or crediting to increase. But the terminology that we're looking for is you debit to increase a debit, which is an asset or an expense. So for example, maybe an asset could be a vehicle, an expense could be electricity, and we credit to decrease that. And then for our credits, for example, a credit could be a loan at the bank, or potentially it could be revenue from your income or capital for your equity. To increase that, we say we've credited it, and to decrease that, we say that we've debited it. So it is a little bit confusing to get your head around. I would recommend writing down this little table here, just in your book, just to kind of try to wrap your head around it before we get into the first one. So there is 11 types of balance day adjustments for level 2 that can be made. So we've got prepayments, accrued expense, accrued income, income in advance, straight line depreciation, diminishing value depreciation, units of use depreciation, invoices issued, invoices received, bad debts, and doubtful debts. Whoa, I know that sounds pretty bad, but if you can wrap your head around these guys, the financial statements are going to be really straightforward. A lot of the financial statements are just kind of inputting data from your trial balance and just copying it into your financial statement. So if you can get your trial balance down pat, and if you can figure out how to do that correctly, then you're going to be in a really good position to go and get those merit, those excellence grades that I know a lot of you guys will be looking for. So jumping on in, we'll look at prepayments. So a prepayment, as you may guess from the name, a prepayment is when your business has paid for something in advance, right? So actually, we're not going to track that up just yet. So for businesses, the financial year that we look at is the 31st of March to the 31st of March. That's one financial year. So the advertising that's been paid for April 2024 is not part of our financial year, right? The financial year we're looking at for this business is March 2023 to March 2024. So we've paid this prepayment in advance. So what we need to do here, guys, is we need to decrease our advertising and we need to create a current asset because we've paid this in advance. if we were, just hypothetically speaking here, to go bankrupt today, we'd be able to get that money back from the money that we're paying for advertising. So what we would do is we would debit prepayments. So what we're going to do is we're going to create an account. And now a prepayment would be an asset because we're going to be able to get the money back for the business. So it's an asset to us. It's cash, right? So we're going to debit that. And because it's an asset, it's going to be on the left-hand side. So we're going to debit prepayments to increase it. And then we're going to credit expenses. Now, if you guys, I know there's a lot of information dumping on you right now. You will start to get it soon. It does take a while. But if we just look at our credits now, our expenses, they're also on the left-hand side. They're also a debit. So by crediting an expense, we're just decreasing it. So we're not even touching the right-hand side of the equation of our trial balance, at the moment. We're just increasing our prepayments and decreasing our expenses. There is going to be a video later on where I go through and do all the examples in the actual trial balance from some of the exams. So they'll be coming soon. But this is just really something to kind of wrap your head around the very basic stuff. So now we have accrued expense. So accrued expense and also accrued income is just a fancy Latin word for due. So it's money that we need to pay as a business. So if we were to go not broke, insolvent tomorrow, we'd still need to pay those wages to our employees, our office employees. So some of you guys might be guessing now, we're going to be creating a liability. So we'd be looking at debiting the expense. So we'd increase the expense on the left-hand side, we'd increase office wages, and then we'd credit on the right-hand side, we'd create an account called accrued expense. And that account would be a current liability. And yeah, so the reason that we do that is so that, I just lost my train of thought. So it's a current liability because we need to pay it back. We're legally obligated to pay those wages, right? So we have to do that. Okay, moving on, accrued income. Quite similar to accrued expense, just on the opposite side. So here we've got a dividend owing. So again, if we were to go insolvent today, that money would still be owed to our business and it'd be used to help repay, say, debts, for example. So some of you might be guessing, we're going to be creating another account. And this time, instead of being a current liability, it's going to be a current asset. So we're going to debit accrued income, which is going to be, again, an account that we make. So we're going to make accrued income account, and that's going to be a current asset, similar to the accrued expense, and then we're going to credit income. So with all your trial balance adjustments, guys, quite often you're going to be creating accounts. So if you kind of are thinking, debit accrued income, what the hell? Why? Who's a debit accrued income? I don't have an accrued income account in my trial balance. That's okay. You're allowed to add accounts to your trial balance, and that's what you're supposed to do. So income in advance. So here we're looking at when we have received money. So we've received an income in advance, so outside of our financial year of 31st March to 31st March. So here we see that we've collected a month of rent. In this example here, we've collected a month of rent in advance. So what we're looking to do here is we want to debit our income, right? So we want to decrease our income because income is a credit. So by debiting it, we decrease it because this income isn't actually part of our year, right? And then what we're going to do is we're going to credit income in advance, which is going to be a new account that we're going to make. And that account is going to be, let's see if I can get that working. Yeah, current liability. And that's because it's going to fall due within the next year. Yeah, so those are kind of the four simple ones. What we're going to look at now is our depreciation, which is also relatively straightforward. So, remembering from... Sorry, I'm a bit sick at the moment. You have to excuse me. So remembering from maybe year 11 accounting or maybe some stuff you've learned in class, depreciation is when an asset decreases in value over time, over the course of its life. So if we just think of a simple example, our car, when we buy a car, say it's worth $100,000, in 50 years, it's not going to be worth $100,000. It's going to be worth a lot less. So depreciation is an expense, and it's looking at allocating out the usefulness of an asset and the decrease in value. So there's three sorts of ways that they can give you depreciation, but I'm only going to look at the two main ones. So the first one is pretty straightforward. So this one is straight line depreciation. So here they'll either give you the amount, just tell it to you plainly, which is super easy, 1560, you just write that figure in, or they'll say depreciation, straight line depreciation, 10%, and the asset was worth 100,000. So it's just $10,000 a year, something super simple like that. Just chuck it into your calculator, easy peasy. So what you're going to do here is you're going to debit depreciation of the asset, okay? Remembering that depreciation is an expense, so debiting it is going to increase it. And then we're going to credit accumulated depreciation. And accumulated depreciation of the asset, but accumulated depreciation isn't an asset. Accumulated depreciation is a liability because it's the money that you've lost over time, and it's the money that's been kind of lost in the asset. And that's going to be on the right hand side because it's a credit, it's a liability, right? And just sometimes they don't have them included in the trial balance, so sometimes you'll need to make a new account on your trial balance. Pretty straightforward though. So yeah, straight line depreciation is pretty straightforward. Diminishing value is a little bit more confusing. So what you want to do here to calculate the diminishing value depreciation is you want to take the cost price of the asset, so the original cost price, and then take away the accumulated depreciation so far, and that gives you the carrying amount, what the item's worth at the moment, and then you take away your whatever percentage of depreciation they give to you, right? Sounds quite confusing. When I go through the trial balance of 2024 and 2023, I'll explain it again there, and it'll make a bit more sense, I hope. But yeah, so just to remember, guys, depreciation is an expense, accumulated depreciation is a liability. With our depreciation, it's always the same way we do it, whether we're working out for diminishing value or straight line depreciation, or sometimes units of use, which I'm not going to cover in this video just because it very rarely pops up, but if it comes up in one of the practice papers, I'll cover it then. But essentially, that's just looking at dividing the lifetime out over units of use. So say they say a car will last 100,000 kilometers and it drove 20,000 kilometers, then we'd depreciate it by 20,000. Guys, just one quick thing to talk about that I just realized I haven't written down here is the residual value of an asset. So not always, but sometimes they will tell you, say we paid 100,000 for this car, the residual value is 10,000. So you want to then what you'd have to do is so the residual value is pretty much means that no matter what, even in 100,000 years, there's still going to be this residual value. In reality, there wouldn't be, but just for the purpose of this NCA exam, that's what it means. So when we're looking at calculating depreciation for straight line depreciation, we want to go the cost price minus residual value. So sorry for not writing that down. Definitely include that in your notes if you're taking some notes in this video, because it's very important. Okay, looking on to invoices. So as a business, we're going to receive invoices and we're going to issue invoices. So if we're issuing an invoice that hasn't been recorded yet, it means that we've had some income that's not recorded yet, right? So what we're going to do here is, to start with, we're going to think about our accounts receivable. So remembering that our accounts receivable is money that's owed to us, okay? And it's a debit. It's an asset. So what we're going to want to do is we're going to want to debit accounts receivable. We're going to want to debit it because we're owed money, right? It's going to be increasing. And then also remembering that we've had some sales that have been unaccounted for, our sales / our fees. So we want to credit those on the right hand side, remembering they're a credit. And if we credit a credit, increases. And then finally, we want to credit GST. And now this is something that's really important, guys. If you haven't taken any notes so far, please take a note on this. Your GST can be a credit or it can be a debit. Now that sounds a bit confusing, but just think about this. Normally it will be a credit, almost always, 9 times out of 10, which just means you have to pay the GST. but sometimes you will have a positive GST balance where money is owed to you, and in that case it would actually be a debit on the left hand side. So the thing about that, guys, it would be an asset, sorry, it'd be an asset. The thing about that, guys, is you've always just got to credit your GST, and whether it's a debit or a credit, it doesn't matter, because if we just remember from the very start of that video, that table that I showed you guys, we're always just going to be crediting it. So yeah, that's kind of the gist for invoices issued. Looking on to invoices received, reasonably similar. It's just a business, we haven't paid a business properly yet. So as you guys can probably imagine, we want to increase our accounts payable, which is our current liability, right? It's account money that is owed to others people, money that is owed from our business to other people. So we're going to credit accounts payable, and down there at the bottom, and then we're going to debit our expenses. We're going to increase our expenses, because remember, expenses are debits. So by debiting a debit, it increases, and we're going to debit our GST, which could mean to increase our GST, or it could mean to decrease our GST, depending on whether or not GST was a credit or a debit. I know this is very hard to wrap your head around, debits and credits for GST. Just once you really start doing a practice test or two, you're really going to start wrapping your head around it and understanding a bit more, but I know it can seem a bit daunting. Daunting right now. And now just quickly, guys, sometimes they'll chuck a bit of a curveball at you. So what they might do is invoices received for purchase of an asset. You might see that and start freaking out. NCA accounting help didn't help me, but don't worry. It's actually quite simple. It's just the same thing, except instead of debiting expenses, we debit our PPE or our asset. PPE standing for property, plant and equipment, which is just a category of assets. And we still debit our GST and credit our accounts payable. So those are looking at the invoices. And now we'll get on to the last two, which are a little bit harder. So bad debts and doubtful debts. So a bad debt is when money has been owed to the business. Say maybe it was a customer on credit and they never paid us back. And it's gotten to a point where we're saying, okay, they're not paying us back. So what we want to do here is we want to debit our bad debts, right? So our bad debts are on the left-hand side. They're an expense. We want to debit our GST, increase or decrease it, depending if GST is a debit or a credit. Bit confusing. And we want to credit our accounts receivable, because so we're going to be decreasing our accounts receivable because this money is being written off. Okay, we're no longer going to get this money. It's not coming back to the business. Okay. So this one is kind of a bit easier to understand. And then doubtful debts is when it gets a bit confusing. So we're potentially getting the money back. We're not 100% sure. So the way that doubtful debts is calculated is it is a percentage of accounts receivable. Okay. So there's already going to be an account for doubtful debts in the. Actually, scrap that. There might be, there might not be. Don't bank on it. But pretty much what we're looking at here is we're going to debit our doubtful debts and we're going to credit our allowance for doubtful debts. And now this is if the allowance, this is getting a bit confusing. This is the most confusing one. This will definitely take a practice test or a question or two to wrap your head around. Don't worry, I'm going to go into more depth in this when I do my walkthrough of the trial balance for 24 and 23. So nothing to worry about, guys. But yeah, so pretty much what we're looking for is if we have to increase doubtful debts. So at the moment, if our doubtful debts is below 2.5% of accounts receivable, we need to increase it. We're going to debit doubtful debts and credit allowance for doubtful debts. If it's the other way around, we need to decrease it. We're going to credit doubtful debts and debit allowance for doubtful debts. If we have to decrease it, we have this really weird situation where we're going to debit an allowance for doubtful debts that's going to be a negative expense. Don't worry about that too much. We're going to go through it a bit more in the next video, but in my next video on 2.3, but not too much to worry about, guys. Yeah. So that kind of wraps up every single adjustment on your trial balance. And then there's just your closing accounts. So this is super, super easy, and this is some really, really good way to get some good achieved marks. If you're just kind of looking to go for an achieved kind of grade, you can definitely pick up some super easy marks here that you'll be missing out on if you don't know how to do. So closing accounts, the purpose of this is to kind of close our accounts and put them into the income summary, right? So there's 4 accounts in the income summary. So there's the incomes, your expenses, and then you've got your income summary and your drawings. So to close an income, we just do the opposite of what it is. So we debit the income and then we credit income summary, right? So our income and our expenses, they go into our income summary, and then our income summary goes to our capital, and our drawings also go to our capital. So it's a little bit confusing to wrap your head around, but write this down. So income and expenses go to income summary, and then income summary, and then on a new line, right, in drawings. So drawings are separate, it's just kind of like a standalone, and the second kind of stage go into capital. So to close an expense, we just do the opposite, right? So we do debit our income summary and we credit our expense. Okay, so we just do the opposite of what it is to make it equal 0, right? So debit account needs to be credited, our credit account needs to be debited. Pretty straightforward. Then for closing our income summary, we're going to debit our income summary and we're going to credit capital. And then to close drawings, we're going to debit capital and credit drawings, right? So I'll post a picture of some notes for these guys, but maybe on Instagram, check it out, NCA Accounting Help, if you're not already. But it is very straightforward, and this is really a good place to pick up a mark or two. Just to remember, guys, one thing is that income, expenses, and drawings and income summary, they're going to be the only accounts that get closed, no other accounts. So you don't need to worry about assets or liabilities and that sort of stuff. Not relevant here. Yeah, so that kind of wraps it up, guys, for this video. It really does come back to the trial balance and making our adjustments. And then just going back to the very start of this, is this here. If you're new to accounting, even if you've done it, it's really important just to kind of wrap your head around this concept here, because once you wrap your head around this table, you're really going to be able to start understanding a lot more stuff, and all the blocks are going to kind of start falling into place. Sorry about my voice, guys. I'm a bit sick at the moment, but I hope you enjoyed the video, and there's going to be a lot more videos coming out soon, with some level 3 content coming out soon as well. So stay tuned, keep an eye on the TikTok and the Instagram, and have a great rest of your day, guys.